3, 2, and a 1 time.
There we go.
3, 2, and a 1 time.
1 time where we are starting raw for those who are watching this first episode of Johnson Wealth Advisors Podcast. Thank you guys for coming.
Episode numero uno.
I am Elvis Johnson, financial planner extraordinaire. And to my right, we have
Ezra Davis, and I own a company called Leggett, where we help people open LLCs, S corps, those such things.
And to my left, the not only audio engineer extraordinaire.
Not a financial advisor. So my name's Max Hughes. I develop websites and software platforms for anyone and everyone looking for one. So, but this show's about you, my friend.
This show's about the people.
Oh, ooh, that was a good one.
I mean,
I
it just
like
is what it is. You know, it's about the people.
Yeah, you're right.
So, wanted to start off with this first one, kind of addressing something that a buddy of mine, Byron Thomas, your veteran mortgage loan originator, with Be My Neighbor Mortgage.
Yeah.
One thing that he said on his YouTube channel was about paying off your house early, and what that means for people financially and all that. So, got my notepad here with the proper stats. Byron, correct me if I'm wrong. You said a $300,000 house at 3.5% interest, 30-year fixed rate. If someone was to put $500 a month, they'll pay that house off in 20 years.
Yeah.
10 years early, save $58,000 just in interest payments.
Yeah. So what's the debate now? So that's his advice, a mortgage broker, right?
Correct. The mortgage broker said don't pay it off early.
Don't pay it off early.
Right.
Okay.
Because if you pay it off early, you're only saving $58,000.
Well, you're saving $58,000 in interest.
Correct.
Right? Oh yeah, because you still have to pay off the full principal amount, and
Right.
then that just lessens the interest because you're shortening the time.
Right.
Okay.
Okay.
Perfect.
Well, and you paid off in 10 years. So that's 10 years of
fewer.
not making payments.
10 years fewer.
Correct.
Right? You pay it off.
So it's a 20-year loan.
Yeah. Okay.
Right. Well, his numbers, he said, well, what do you do with that extra money? You invest that extra money.
Mm-hmm.
Would you rather have a paid off house and not have cushion or money in an investment account? Let's say if you budget was a little tight.
Yeah, that's a good point.
Would you rather pay it off and I pulled up to date numbers here because that video was a little bit ago.
Well, hold on though. Are you going to get into like what the results are? Right?
Well, I could. Oh, well.
Yeah, I want to kind of guess on it right now.
Okay.
I feel like it'd be better to guess.
No
right?
problem.
Okay, so the question is, what's the value of the $500 a month, right? That you would be placing extra.
Well, yeah. Where would it be best used at?
Yeah.
Paying off your house or investing?
Yeah. Okay. I mean, if you look at it over the last probably week and a half, 2 weeks, it's probably not going to be that good. But yeah, I think so. I mean, yeah, you and I have had these conversations before because you're my financial advisor. I'm all about the investing the money, right? I think that having something that can grow, housing is always going to be a need that you're going to have. Whether or not you have a mortgage, you always have maintenance, taxes, insurance, upkeep, all of that fun stuff, right? And then people get bored of their houses, right? So what's the average length of owning a home in this country? Isn't it 7 to 10 years?
Well, I know they refinance or they move every 7 years on average.
That's right. Yeah.
I don't know the exact. I think we refinance in this country a little sooner than we move, but we only live in a house for 7 years.
Yeah, which is crazy. It's crazy to me. It's like the largest purchase that someone will ever make in their life, except for student loans.
To the show our commitment problems.
Yeah, you're probably right. You're probably right on that.
Well, how long have you lived in your house?
Too long. 13 years.
Oh, so you're better than average.
Yeah, I'm a mutant.
You've paid a mortgage on that for 13 years? Oh, okay, so you bought 2004? No, 2014. No, 13 years. 2012.
12.
Yeah, I can do that. That's okay.
I guess it's been a little longer than that. Technically, it's 2009. That's when my wife technically got it.
Oh, okay.
We got married and all that good stuff.
Yeah.
Okay.
So she's owned the house since 2009. And have you been making extra mortgage payments?
Mm-hmm.
Yeah, okay.
Yeah, we pay, 50% of our monthly mortgage extra, 50% extra of that on top of that.
Every month?
Mm-hmm.
Oh, okay.
So it brings our 20-year loan down
I was gonna say it's
Yeah,
almost
half-
over.
half
right?
almost done.
Yeah, back in 2009, that's at the bottom of the market, so that house has got a lot of equity in it,
Mhm.
right? Anyway, I take it you're differing opinion than me, right? So I'm about any extra cash go towards investments. You can always have that account. It does what it does, and then you can leverage against it later. But you've gone the other route.
Yeah, I mean, if I wasn't married,
Mhm.
I probably would just continue to give Elvis all my money.
Good point. Yeah, good point. Good point.
But there's two heads, and so the agreement in my house is two yeses, right?
Mm.
On anything, and you need to do some mortgage, some investments.
Yeah.
So it's split. So that $500 would be 50-50 for me.
Yeah, 250 going.
towards an investment,
yeah.
250 going towards a house.
Yeah.
Well, I remember I bought my first home back in 2011,
Mm-hmm.
and working in the banking field at that time, I was a branch manager at a bank, and working in that field, I've done the math on these things. I see what it takes.
Yeah.
And rates were a little bit higher, so I think my mortgage was right around 5%.
In 2011.
2011.
Oh, okay.
And at that time, I did the 30-year note.
Mm-hmm.
Okay, fine. And I was, I guess, also not stereotypical American. I refinanced my house after 2 or 3 years,
Okay.
but I refinanced it onto a 15-year note.
At a
because
lower
that-
rate?
at
Oh
a-
yeah, 15 years.
It was a slightly lower rate, but it wasn't about the rate.
Okay.
It was about paying the house off early,
Yeah, yeah.
right? Well, for me at that time, when I bought the house, I was a personal banker. Okay,
Mhm.
great. Then I was promoted to manager, making more money now, got a little bit more expendable cash.
Yeah.
And I said, okay, I know I don't want to pay on this house for 30 years.
Yeah.
I know that. But what can I do? Well,
Yeah, yeah.
15-year rate was lower. And then I, talked to my mortgage broker at the time, and I said, hey, what's the payment look like on this? And the 15-year payment was only $400 more.
Wow. God, I miss those days.
Right. So I was paying $1,400.
Yeah.
But again, that house was only $150,000.
Yeah. What's
So-
that house worth now?
I
Makes
don't
you
even
wish you
wanna
would have
know.
held on to
Yeah,
it.
a little bit. Yes, yes. So, no, now it's like 400. It was a great starter home.
Yeah, yeah. For sure.
4 beds, 2 baths. It was on a dead end street.
Yeah.
Great starter home. And like I said, yeah, I wish I would have held on to it, but
Yeah.
I refinanced to pay more to pay it off sooner.
Yeah, yeah.
Okay, back then. And like I said, Max, let me throw it into the investments category.
Yeah, that for me is it's always been kind of, I mean, we're all probably from the same similar backgrounds, especially economically, right? I mean, we didn't have a lot of money growing up. So for me, it was always like, put your money in a situation where it's not only protecting you, but protecting itself, right? And so like if you have an investment account or retirement account, I had a grandfather that was, oh Jesus, he was 22 years. Yeah, 22 years active duty Air Force, 24 years of civil servant. And so when he retired after his 22 years in active duty, he had military pension, but also he had I don't know if they called it the same thing, but it was the TSP, right?
Well, it's still TSP now.
Yeah, the TSP thrift savings plan. Yep, yeah. So he had that account, and then he just didn't touch it because he ended up going from what he was doing in active duty to doing the same thing on civilian side, and then he just kept using that same account, right? Because it was his account. So when he retired, I just remember when I was younger, before I could comprehend. He died when I think it was 20, 23, 20. 22 or 23, something like that. When he died, I really started kind of paying attention those last 4 or 5 years of his life, because he'd I'm moving out of Vegas, and I'm moving up to Spokane, Washington, and I'm just gonna buy a house. I was like, oh, okay, cool. What's the mortgage? And he's like, nope. I just bought it. Yeah, just sold off some stuff and bought it. I was like, what? And I just never. I remember hearing that, and I was thinking damn, that sounds like a really important big deal. And I was like, oh, okay, cool, that's awesome. And yeah, it is a huge deal.
Yes, it is.
Buying a house cash is impressive, and it's usually only reserved for the uber wealthy or someone that moves from California that they've had a house for 40 years. But
Yeah.
I mean, to that extent, I just saw the power of that, and being yeah, he doesn't care. He just dropped $300,000-$400,000 in a house. without blinking.
Didn't blink. Yeah. Like you said, it's important to recognize the background because I did that move, before I was a financial advisor, and I did that move because of my dad.
Yeah,
and
exactly.
My dad always said, you don't want to owe nobody nothing.
Yeah.
I never saw him use a credit card except for one time when he bought me a basketball hoop to put in the backyard.
There you go.
That was the only time I ever seen him use a credit card. And I know that he paid off the house. I think I was maybe early high school, maybe middle school. I know he got a settlement from a car accident or something like that.
Oh.
I don't remember exactly what it was, but he was always working. He always saved money. But I remember him saying something about, hey, we're not going to have to pay off this house, and we were thinking about moving. And he said, well, then I'm gonna have a mortgage payment.
I don't want that.
Right. And he was asking me, well, hey, do you want to move? And of course, as a kid, you're like, yeah, my friends live here. I don't want to move. But
sold, paid off.
But it's that background to say, well, my dad had a paid off house, and that was cool.
Is he still in that house?
Still in that house.
Perfect.
And so that background matters a lot.
Oh, yeah.
On what you learned coming up.
Yeah.
Because I also learned to don't mess with the stock market. You'll lose your money in there.
Yeah.
That was what I was taught.
There's a lot of fear on my side of the family with that too.
Yeah, so I think people just get taught fear, a lot of fear, and then what we do learn is misinformation.
Oh, 100%.
I thought the stock market were dudes in the room. I don't know if they still do that.
Yeah, on the trading floor.
Yeah, the trading floor. Yeah,
I thought that was.
They don't do that anymore.
It's crazy.
Yeah, it was. It was Eddie Murphy, Dan Aykroyd, Trading Places.
Yeah, that's right.
Yeah,
I watched that.
Yeah.
And for me, it was always don't have credit cards. Don't get in debt. And so, that was right when I got married, and so we paid off. I just got my vehicle, paid that thing off almost immediately. Paid off my wife's car. Almost that's all we did. I had student loans. And we spent a ton of time just everything we did just went straight towards it. Didn't play around. Didn't mess around because you don't want to be in debt.
Yeah, owe no man anything.
No.
Yeah, or owe no man nothing. What is that? But what does the math tell us? Because our feelings tell us one thing.
Yeah, no, that's a good point.
Our
so
tells us something.
And our history, our background tells us something. So what's the math tell us? So took my little notes here, and again, Byron says that'll save $58,000 over that 20-year period.
Yeah.
Okay.
House is paid off now. Congratulations, and you saved $58,000.
Sounds good.
And that's going from a 30-year note to a 20-year note.
Correct.
Right. So we're talking about if you have, so the number is, does it beat $58,000 or $55,000 in savings over a 20-year period, right? Because that's how long that mortgage ends up being.
Correct.
Okay.
So you saved $55,000, and if we just put that into a benchmark of a 60-40 portfolio.
What's a benchmark mean?
So just indexes.
Oh,
we
okay.
just used the stock market, the S&P 500 index, 60% of that money.
Yeah, not picking Tesla or Amazon or
not
anything like
picking
that.
just putting it into the index.
Yeah, betting it on the stock market.
And then the other 40% of that money goes into a different index, a bond index. So that's a 60-40 portfolio. Okay.
60% stocks, 40% in bonds.
Right.
Okay.
Just in that portfolio, that money would have turned into $180,000, and I'm rounding just for saving space on just notepad purposes. So $180,000 and some change is what that money would have turned into in a basic benchmark.
Interesting. So
if you put it all in the S&P,
it's
$376,000.
So at the most conservative stock market play, you would have gained $120,000 more.
And that's just being balanced.
Yeah.
Yeah.
Wow.
Not for those who are aggressive. Again, also not for those who want to just throw it in the savings account.
Yeah, exactly.
But just kind of
0.01%.
Right, just kind of keeping it moderate.
Yeah. Okay.
180,000.
Wow.
So that's $6,000 every year that you're putting away.
Yeah.
And then of course you get the growth.
So it's $120,000 though total after 20 years. I'm assuming my math is correct. Or am I way off?
No, yeah, that's why I asked it before he said that number, right? So that $500 a month
Right.
would be
120,000.
Yeah, because it's applying.
You're
You're either applying.
genius.
So I want to do that.
you're applying $120,000 over the 20-year life of a mortgage to pay it off in 10 years early, or you're taking that $120,000 and investing it every month over 20 years in an account. So your mortgage still carries out to 30 years, right? Which would cost you $55,000 more in interest.
58.
Or 58,000, yeah, 58,000 more in interest, right? Well, and at that time, oh no, actually, so you would receive $180,000 10 years sooner than when your mortgage would be paid off.
Correct, but
right?
that is being on the slow lane, so to speak.
Yeah. So
we just put that in the market, because like you said, that's 120,000 of the 180. You only really gain 50 grand or 60 grand.
Right. You're gonna save 58,000.
Okay. Well, what if it was 376,000? Because that's what it would get you in the S&P 500.
Yeah.
So now it's a totally different game.
Yeah. Now we're talking.
Right.
Now it's worth an argument.
Right. And then now let me bring forth a different argument to really make it worth it for you. So I just kind of ran this back, and of course, every financial advisor runs their own portfolios.
Yeah.
So I ran this back in my 60/40 portfolio, and it's 720,000.
Okay.
So is that worth an argument?
Yeah, for sure.
Absolutely.
So I look back at me and I think about it like, man, what if I would have known that back in 2012, 2013?
Right.
2000.
Like, oh my gosh, what would I have done?
Really.
Like a lot of things that I know now, like I'm pretty sure a lot of things you guys know now, like what can I go back and slap into my 18-year-old self?
Yeah. What's that saying? Youth is wasted on the young.
Completely.
Yeah.
It's completely wasted.
Yep.
So I mean, let's just talk about the straight S&P 500, 376,000.
Yeah.
Okay. Well, then the thought line is though, well, if they saved 58,000, instead of paying it off in 30 years, they paid it off in 20. That's an extra $1,000 a month they could have put in.
Yeah.
Okay. Well, if they did that for the next 10 years, if they, paid their house off in 20 years and then invested the whole $1,000, the mortgage payment turns out to be like $1,300 or something.
Yeah,
what if they invested the whole $1,000?
This is still assuming 3.5 right now.
3.5, correct.
Because that wouldn't work today. Today's market, right? It's like.
I mean, you can probably buy your rate down to that, but we'll have to bring Byron on and have him give us some rates.
Well, but I mean, even still though, like you could look at it from a payment perspective, right? Because you're talking about if you go back to 2011, right? You said at a 5% rate, right? The markets were also not seeing as big of returns as they are today because of the environment, right? So I would imagine that translates to what the current mortgage rate is and what the monthly mortgage payment is to what the earnings are in the stock market, which you'd probably be able to see, right? So home values, would they increase by last year, like 20%, like 15%?
Not last year, no.
No, oh yeah, and not last year, but
no, but over time, historically,
yeah,
real estate increases by about 6%. The market increases by 10.2, depending on who you talk to. Some say, oh, you got to take out inflation. Okay, 8.
Yeah.
So it's still the market grows better than real estate, right? Okay. But then you got certain markets. Because the Tacoma Seattle market did not only grow by 6% over the last few years.
No, yeah.
So we're definitely different.
Yeah.
But
so is Alabama.
The hottest market in the country, right?
Yeah.
So.
What?
Turn up the mic real fast.
Yeah.
I think you're 2. Yeah.
So there we go. That's all right. But so yeah, we're the hottest market in the country for a while.
Yeah.
And then you got places like Cleveland or Columbus, Ohio,
Detroit.
You can go buy a whole house for 20 grand.
Yeah. No,
and I've known people who have done that. They go buy the house for 20,000 and say, okay, great. Some of them needed to put another 20,000 into it. Some of them needed to put some spit shine on it and then rent it right out. It's like that's great cash flow. Yeah.
Well, and the problem that you have in markets like that, right, is that not a lot of people have income. They don't have steady income, right?
Right.
So
where the housing prices are low, so are their earnings.
Exactly.
Like I said, I just look back and say, well, in that market time, well, let me finish this part. So if you took that $1,000 over the next 10 years.
Oh yeah, okay.
Okay, and invested it. Now in the S&P, you're talking about 228. So double the money. So after 30 years, you'll have 228,000 in a paid off house.
Yeah.
Or after 20 years, you'll have 376,000 and still be making payments on your house.
Well, yeah, So, but hold on, it's 220,000. So if you took that extra $1,000 a month,
So yeah, you pay you
For
let's say
10
your
years.
payment. Let's say your payment was a little over $1,000.
yeah,
Okay, and you were paying that 500 extra. You save 58 grand
yeah,
on your interest.
Yeah.
Right, and then you said, okay, well, I'm going to pay now 1,000
yeah,
into my investment account.
and that after
So
10
You
years,
did that for the next 10 years.
yeah,
You guys still gotta lose 500 you be putting aside then.
Well, I just did the math on that. I can do it quickly again.
yeah,
But either way it goes, it's only 266.
yeah, but that's
It's not
also,
going to catch up.
but the total value of that should also, in my mind, include the $58,000 in savings from the interest, right?
Okay, so now we're at 310
yeah, 310, right?
as
But
opposed to 376.
exactly. But the other part about that is that that's not on an even time field now. So if you're talking about doing that, it's like, what happens if you take that $500 a month and let your mortgage ride out for all 30 years? Now you're talking about what's the value of that investment account, $500 a month for 30 years investing instead of 20.
Mm-hmm.
Yeah, and on top of that, at some point in time, it's gonna become enough to where you can put everything like dividend stocks.
Yeah.
And then use that money to take care of all the upkeep
Exactly.
and all that stuff of your
Yeah.
property.
Well, I just quickly used the good old trusty handy dandy calculator and said, okay, well, what if you just let that 376 sit
Mm-hmm.
for the next 10 years,
And not invest anymore, not contribute anymore.
not contribute anymore,
Okay.
just to put us on a 30-year scale.
Gotcha.
So
okay.
I see Mr. Nosy over here done already
Of
peeked
course.
at my calculator. So what do you think that money's worth now in the market?
With another 10 years?
Another 10 years of no contributions.
Probably 700,000.
$811,755.80.
Wow.
It's hard for me to believe that.
Math doesn't lie.
Emotionally.
Yeah.
Math is
does
math.
lie. Don't say that to me. To statistics.
Well, statistics, but this is pure time value of money.
Yeah, yeah.
But no, that makes sense.
Yeah, which is crazy because, so if you invested $500 a month, timer, 22. Oh, yeah, we're at 22 minutes.
Cool. Try not to keep you guys all day long. That's all.
That's right. So if you invested, so what this translates to is that if you invested $500 a month for 30 years in just the standard market, right? Just a 60-40 market split, right? Is that what we were talking about?
I was talking about the standard S&P.
Oh, the standard S&P. Okay, so if you put $500 a month for 30 years in the standard, no, for 20 years,
20 years.
and then you had that account for 30 years, you would
Mhm.
have over $800,000 in it,
Correct.
right?
Mhm.
If you took and a paid off house, right?
Yeah, at 30 years,
Yeah,
yes.
30 years and a paid off house. If you took that $500 extra a month and put it towards your mortgage, and then all of the mortgage amount from years 21 through 30, you invested that, you would have a paid off house and an account with 400,000? But no, 310,000. That's what we said, right?
It's a little bit different. That part was if you just put 1,000 away. So I'll do the math real quick to say, what if you put it all?
Oh,
On
so
your
1,000 plus, yeah,
So the whole 1,500, let's
yeah,
say.
the whole
Okay.
1,500.
So that's an extra 10 years, and let's say we get market rate. We start out with nothing, and we're putting 1,500 a month up. You know what?
For 10 years.
I did not change this. For those of you guys who know financial calculators, always make sure to change your payments per year. You
Right.
don't want to make one payment of $1,500 a year.
Yeah.
So $1,500 a month for 10 years is 120 months. Market rate starting out with 0, you end up with 307,000.
Okay.
So after
Plus a $58,000 value savings. So the value of that
okay, so plus the
proposition
58,000,
is 365,000.
365,000.
Okay, so after that you've got 365,000.
Correct.
Right.
And that's 58,000 of that is an accounting trick.
Yeah, exactly. Wow.
Depreciation. or
So
whatever.
that's $500,000 more in money. And at the end of both scenarios, you have a paid off house.
Correct.
So that just shows what the importance of being in the market early and long translates to.
So there's three things I always say, and so you guys have probably heard me say this before. There's three things that you need, and where I get a lot of these sayings from is when my kids were younger, I'm trying to explain it to them.
Yeah.
And they say that people, Americans, have a 5th grade financial education
Yeah.
anyway. And so I said, okay, well, I want to be able to explain this to my children.
Yeah.
And at the time they were in middle school. A couple of the ones I was talking about were in middle school.
Yeah.
Now they're grown. and I said, okay, if they can get it, then anybody can get it. What can I break these things down to?
Yeah.
There's only 3 things we can do with our money.
Okay.
Okay. And we have to do all 3 of them on purpose. And we can, argue for another hour about the semantics and the categories. Okay.
What it looks like and everything.
But there's 3 things specifically that we can do with our money, and we have to do them on purpose. You have to save some.
Yeah.
And inside savings, investing, and all that good stuff. But you save it.
Yeah.
You spend it,
Mm-hmm.
and you give it.
Oh, yeah. Yeah.
Okay. Because if you can't give all your money away, that's irresponsible.
Yeah.
Right. It's good to give some, and money is reciprocal.
Yeah.
But just the laws of money, the laws of anything. I want respect. I give respect. I give respect back.
Yep.
Right. So you got to give some money. That's just the right thing to do.
Yeah.
You have to spend money because we need food, we need shelter,
Yep,
all that type of
exactly.
stuff, right?
Yeah.
And we need fun.
Yeah.
I budget going to the movies and getting that movie popcorn. It's in my budget. Okay?
Right, there you go.
I'm getting the movie popcorn.
That's right.
I might bring in some Reese's Pieces myself, but I'm buying that movie popcorn.
That candy pocket.
That's right. So it's in the budget, right? So you got to spend money.
Yeah.
And you got to save money.
Yeah.
Because as we know right now, looking over the shoulder in the Pacific Northwest, it's gonna rain one day.
Oh,
Okay.
smooth. I like that.
So we have to be prepared for those rainy days.
Yeah.
Spend some, save some, and give some.
Yeah.
Okay, and do all 3 and do them on purpose.
Yeah.
Just to drop another trinity on there, where I was initially going with this is, there's only 3 things you need to be financially free.
Mhm.
Okay, you need discipline,
Mhm.
time, and consistency.
Oh, yeah.
And apparently the facts, because man, if I have those things, but if I had known,
Yeah.
Well, I mean, what do
About that.
if you need the facts, because you need to know why you're going to be disciplined,
Yeah.
and the consistency to do what. I consistently ate Chips Ahoy cookies for a long time. So, I get the result from eating my
Yeah.
Chips Ahoy cookies, right?
Mhm.
But with discipline, time, and consistency, speaking financially, you got to have the discipline to budget your money,
Yeah.
and to live below your means and all that good stuff. You got to have the consistency to not just do it every other month or here and there. You got to, if I want to see change in my weight, I need to eat right and work out consistently, right? And then time is our friend.
Yeah.
The power of compounding interest. Time is just our friend.
Yeah.
So then now if you lack one of those 3 things, then you need more money.
Oh, yeah. No, that's a good point. I mean, people underestimate, especially in this country, because everyone wants like the big hit and the big win and the big, whatever, the big payout and all that stuff. People really underestimate like what the power of like $50 a day does, like $100 a day or something like that, or even a month, right? When you talk about it from an investing standpoint, or like for me, I still have student loans that I'm paying off, right? So like my minimum payment, if I put an extra $200 a month on top of that, like it makes such a huge impact, and but you won't see it for 5, 6, 7, 8 years, right? But then you start seeing like when that stuff starts coming down and you're saving so much money, and then the time is going to go by anyway, right? So it's like if you just set it and forget it, and an extra $250, like $200, I'm not going to notice that. It's not going to mean anything to me. For some people it might, so it's it's an extra $50 or $100 or whatever it ends up being. But you doing that every day, every month, like for 5, 10 years straight, like
So now I can show it to you. Don't say that.
Okay.
That's the power of $100 a month in the market for 30 years.
Yeah. See, and it's crazy. And so many people I know, like it doesn't matter how much you earn, where you're at, what your living situation is, everybody can find $100 a month.
What's
Right.
it, 187? What is it?
What do you think it is? See, he had to guess last time, so
I said it
187.
226. I was way off.
Yeah.
$100 a month consistently.
Consistent.
The discipline to not go out and eat
What percentage are you
McDonald's
using?
or I'm sorry,
What percentage were you using?
10%, just average
It's
market.
10. Oh,
Yeah.
yeah.
That's nothing super spectacular, just
Yeah.
market averages.
Yeah, and that's 10% is around the market average for what the stock market is
Historical
doing.
market average, not including inflation.
Yeah, for like what, 80 years?
More than that.
Yeah, 120
100
years
plus
or
years,
something. Yeah, exactly.
So it's you got to have the discipline to take out. Some people call it your Starbucks money or whatever.
Yeah.
Whatever you spend a couple bucks a day on,
Yep.
or a couple bucks a week on. It could be. I don't bring my lunch to work every day.
Exactly.
And you go spend $10 a day at lunch. You go to McDonald's every other day or Burger King every other day. There's your $100 right there.
And you don't even have to do that for the entire month. You can. That's just 10
Right.
days, right?
Right.
If you do 10 days, 2 weeks, 2 business weeks of the month, and you don't eat out $10 a day, then which is
There's your
that's
$100.
10 years ago, right? I mean, lunch now is $20 if you
That's
go
true.
anywhere.
Okay,
so if you do that for
10,
5
10
days,
10 Starbucks trips.
10 Starbucks trips. If you cut out 10 Starbucks trips, right, in the morning for 2 weeks out of the month, you have that $100, and then you can put it in there.
So we got the discipline to cut out, a little bit of coffee, drink coffee at work, make your coffee at home, whatever it may be. You got the consistency to do it on a regular basis, and you do it for a long period of time.
Yep.
There's $250,000.
Man,
Sounds like a great place to end
with
on.
that, we're at 30 minutes, man. That's an episode right there.
Well, I would like to talk about next time that DTC, because in that discipline, like budgeting and all that good stuff.
Oh yeah,
We should definitely discuss that.
Yeah.
absolutely.
Well, and also we want to make sure that we get questions from people to answer your questions.
Yep.
If there's a topic that's close to your heart, been on your mind, let us know in the comments. You can shoot me an email, Elwis, ELWIS, at johnsonwealthadvisors.com. Of course, disclosures will be all over this.
Because he is a real financial advisor.
Right, fully licensed, look it up, broker check, all that good
Yeah,
stuff. So,
exactly.
johnsonwealthadvisors.com. You can go on there, you can submit a question there, or shoot me an email directly. Give us a call, 253-356-8612. Angie will love to talk to you. She's going to love that I put her name out there like that too. But she'll love to talk to you and take
I
that
can't wait
question.
to hear about the first call. Hey, is this Angie? What? How'd you get my name?
But yeah, we'll bring those up. And again, if it's something that is, specific, I've said this to people for many years, when I was doing seminars, I don't care what you want to learn about. What I'm trying to do is bring value.
Yeah.
So if you want to learn how to change your oil, then let me run down the street and get a mechanic.
Yeah,
And then we'll do a class on how to change your oil.
exactly.
So whatever it is that people want to know, that's what we'll talk about and bring some facts to it.
I like it. That's all, folks.
See y'all next time.
See you.